Hello and welcome. My name is Jeffrey Kennedy and welcome back to another episode of Elliott Wave Junctures. If you recall, earlier in the month we looked at actually a head and shoulders formation in the Dow, in the S&P, in the NASDAQ, and the Russell. And this head and shoulders formation was on the intraday price chart level. And what we were looking for specifically at that time, it was right about here where we were looking at the potential head and shoulders pattern. Here was our left shoulder, here was our head, and here was our right shoulder. And this was the E-mini Dow contract. And essentially what we were looking for at that time was for prices to continue lower and actually penetrate the neckline. Okay, now the neckline is the trend line between the two extremes between the left shoulder and the head and the right shoulder. This trend line right here. And what we do whenever we draw that neckline, we actually like to take a parallel of that line and put it against the left shoulder, the extreme of the left shoulder, and many times it actually acts as resistance for the right shoulder. But what we were looking for at that time was a break of the neckline, and as you can see, that actually never happened at that point. So in other words, that pattern or that identification essentially became invalidated because we never actually had the confirming price action. Well, I think we actually might have another head and shoulders pattern formation actually occurring short term in the same markets, the E-mini Dow, the E-mini S&P, the E-mini NASDAQ, and the E-mini Russell. Okay, here would be the left shoulder right here. Here's my head. This was a downward sloping. Yet actually it's kind of a severe downward sloping, but I can live with this. And here we actually have the right shoulder. Now as you can see, here's the neckline at this point. So I'm wondering if we can actually get below this level within the next day or so. And if we do, well, if we see something like this, then as we all know, we now performed the neckline measuring technique. And all we simply do there is we simply measure the move from the high to the neckline, which would be, well, let me go ahead and get my cursor back up here, which would be this distance right here. And then we take that distance and we project it downward from the breakout point. Okay, so that would be the breakout point of the neckline. That would be roughly about here. Now, if we actually see that happen, we can actually see the move fall down to, say, maybe 12.1 here in the mini Dow contract here. So that would be a move from current levels when we're currently trading, say, roughly 12.4. That would actually clear the way for a move down to 12.1. Okay, now also to remember, with respect to the neckline measuring technique, these are minimum objectives. Okay, so again, let's keep an eye on these markets the next few days and keep an eye on that move, that area on your price chart to see if prices can decisively penetrate the neckline. Because if we can, then we actually have a downside target for some of these price moves. And as always, if you'd like to learn more about the indices or who follows these major indices, simply refer to the short-term update edited by Steve Hochberg. Now again, here's the S&P contract. And if you recall, earlier in the month, we were looking for the left shoulder, the head, and the right shoulder. But again, we never had that neckline break. So number one, we never had the price confirmation, and thus the pattern became ultimately invalidated. Well, we're back again. Here's the left shoulder, here's the head, here's the right shoulder. And as you can see, it appears that we are indeed working on trying to penetrate the neckline. And if we can penetrate the neckline, well, that would probably project a move down to, say, 12.7 here in the E-mini S&P contract. In other words, we could actually see 2 to 3% price declines in these indices, say by Friday's close. Again, here's the E-mini NASDAQ. And again, if you recall, we were looking at the left shoulder here, the head, the right shoulder, but again, no penetration of that neckline right there. We never saw the neckline break, thus we never had confirmation, thus the pattern became invalidated. Here's currently the operative head and shoulders pattern. Left shoulder right here, here's the head, here's the right shoulder, and as you can see, we may be attempting to actually penetrate the neckline. And if we do, that would probably project down to about, say, 24.75. with respect to the E-mini NASDAQ. And in fact, the head and shoulders pattern here in the E-mini NASDAQ is actually a little bit prettier than what we're actually currently seeing in the S&P and certainly in the Dow. But here's a price chart that I really like. This is the actual Russell 2000. And again, here was our left shoulder, head, right shoulder. Again, we never saw the confirmation, thus the pattern became invalidated. But now look what's forming here. Again, the most recent structure, we certainly can do the head and shoulders pattern again. Here's the left shoulder, here's the head, here's the right shoulder. Technically, this is actually a half shoulder, and if we can continue to see the decisive selling below the current neckline here, that would most likely project down to about, say, 730 here in this index as well. Now again, let me just go back to review why the head and shoulders pattern tends to work and why it goes hand in hand with the wave principle. And let me slide this over real quick and I'll explain why. Okay, with respect to a five-wave structure, or possibly say a complete Elliott wave cycle. Okay, well you have 8 waves within a complete Elliott wave cycle, and what I'm referring to is this would be wave 1, this is wave 2, here's wave 3. Wave 4, Wave 5, waves A, B, and C. In fact, let me just go ahead and make it a bit more clear for you so you understand why, again, why I like to look for the head and shoulders pattern and why it's relevant and why it, again, works in conjunction beautifully with the wave principle. Okay, here's your classic 8-wave Elliott wave cycle. 5 waves up, followed by a 3-wave decline, identified as waves A, B, and C. As you know, with respect to impulse waves or motive waves, there's 2 types, impulse waves and ending diagonals. With respect to corrective wave patterns, there's 3 types, zigzags, flats, and triangles. Now here's just a basic 8-wave Elliott wave cycle. This is waves 1, 2, 3, 4, 5, A, B, and C. So why do I always get excited about head and shoulders patterns? Well, very simple. Look at where it actually falls within the Elliott wave context. There's your left shoulder, here's your head, and here's your right shoulder. Right there. This is why I like the pattern so much. It fits in beautifully with the wave principle. In fact, the wave principle actually subsumes the actual structure of the head and shoulders pattern and many of the formations that Edwards and McGee spoke about in their wonderful book. And again, if you don't have it, I highly recommend it, Technical Analysis of Sock Trends. Again, seminal work and essentially the Bible of technical analysis. That about does it for today, but keep your eye on these markets. These formations are very, very nice right now. And again, if we can get this confirming price action, see these penetrations of the necklines, I think that's going to translate in probably at about 2% to 3% declines this week in these indices. And again, the expert in the indices, or the one person that does follow these markets on a consistent basis, rather than just in and out like I do sometimes with respect to Elliott wave junctures, is Steve Hochberg. So please take a look at that short-term update that he writes. That about does it for today. Thank you very much.